In our previous video, we talked about how market conditions, earnings releases, and news events can influence pair trading and why it's so important to avoid artificial price movements. In today's lesson, we'll move from market behavior to the metrics behind the strategy, the numerical tools that help us evaluate a pair, confirm a signal, and decide whether a trade is worth entering. Let's take a closer look at the key metrics used in pair trading and how each one supports smarter and more consistent decision-making. On this slide, I want to explain the difference between metrics and indicators because both are essential in pair trading and each one serves a different purpose. Metrics are the numerical values we calculate from price, volume, or statistical relationships. They tell us how strong the correlation is, how far the price moved from the mean, how volatile the pair is, and many other measurements. These numbers can help us evaluate quality and consistent. Indicators, on the other hand, are visual tools that use those metrics to show us what's happening in the market. They help us interpret the data, identify trends, spot deviations, and determine possible entry or exit points. So in simple words, metrics give us the raw data, while indicators translate that data into something we can quickly understand and act on. On this slide, you can see a variety of metrics that are commonly used in pair trading. Each one of these metrics has a different purpose. Some measure stability, some help us validate a trading signal, and others indicate risk, trend strength, or statistical behavior. Before we dive into the key metrics one by one and understand how each of them contributes to better trading decisions, let's divide them into three categories. The first category is pair quality, which focuses on the long-term stability of the relationship between the two stocks. The second category is opportunity quality, which helps us evaluate the strength and reliability of the current trading signal. And the third category is symbol-based metrics. These come from analyzing each stock separately. They combine elements from the first two categories, but are unique because they rely on company-specific information, not on the pair itself. Let's go over the metrics in the first category, the quality of the pair. Correlation. This is one of the most important metrics, and I've dedicated a full lesson to it. In general, correlation measures how closely the two symbols move together over time. Cointegration. This test checks whether the spread between the two instruments is statistically stable and mean reverting over the long term. ATR looks at the volatility of each symbol and compares the two. Large differences in volatility can weaken the pair relationship. Half-life. This metric measures how quickly the spread returned to its mean in the past. A shorter half-life usually indicates a stronger and more reliable pair. This is not mandatory, but helps complete transactions quickly. Sector and industry. Are both symbols from the same sector or industry? This is also not mandatory, but related businesses tend to react similarly to market conditions, increasing the likelihood that the pair will remain statistically linked. Now, let's go over the metrics in the second category, the quality of the opportunity. These metrics help us evaluate whether the current deviation is strong, reliable, and suitable for entering a trade. Z-score measures how far the current spread is from its historical mean in standard deviations. A higher Z-score indicates a stronger statistical deviation and a clearer trade setup. Bollinger Band position shows whether the ratio moved outside the Bollinger Bands. A close outside the band is often the trigger that indicates a meaningful divergence. Stochastic, a momentum metric that helps confirm whether the move is overbought or oversold. It adds psychological context to the price action and strengthens the entry signal when it aligns with the direction of the ratio. ADX measures the overall strength of the trend. Lower ADX values are preferred, as strong trends, meaning high ADX, can overpower statistical corrections. DI positive, DI negative. These indicators show whether upward or downward momentum is dominating. Ideally, we want weak or neutral momentum rather than a strong trending environment. News and earnings reports. I covered these in detail in a previous video, but in general, both can create artificial price movements in the symbols. We want to avoid entering trades where the deviation is caused by news-driven or earnings-driven moves rather than by natural statistical behavior. These metrics help us validate that the deviation we see is not random noise, but a real tradable opportunity with a higher probability of mean reversion. Using this information correctly and professionally helps filter out market noise and allows us to focus each day on the pairs that are truly relevant based on the results of the previous trading session. From there, we rely on indicators and historical behavior to decide whether a new position is worth entering. The system I developed performs all of these calculations automatically, analyzing thousands of pairs every day after the market closes. This allows me to focus only on the symbols that meet my predefined criteria. In the next step, I use the indicators I built for the TradingView platform to validate the opportunity and make a confident trading decision. If you'd like to use these tools yourself, I invite you to join the mailing list on my website and register for access to the systems and indicators I've developed.